Is it possible to buy a brand new house with 100% financing? The answer is yes. My name is Troy Funk, and that's Funk, F-U-N-K, Funk, and I have been in the real estate business. I've been a resident of Florida going on 4 decades now, and I've seen a lot of cycles in that time period, and we just came through a real crazy one where we had a low amount of inventory, small amount of inventory, and a huge demand, which created a enormous spike in property values in the last couple of years. Well, the market has adjusted and we are now more in a buyer's market. Good time to buy a house for a buyer because just a few months ago, things were completely different. It was very difficult for a buyer to buy a house, even with financing, let alone 100% financing, as sellers were receiving so many offers on their property that we started this new terminology called appraisal gap, where buyers were needing to pay considerably above what the appraisal price of their property was in cash just to secure financing. Well, with 100% financing, obviously that doesn't make sense. And in this marketplace, we're seeing 100% financing become an option again. So how do you get 100% financing? Well, there's several ways to do that. The first one is if you're a vet. And if you are a vet, first off, thank you for your service. As a vet, you have the option to secure 100% financing with a VA loan. Another option is the USDA. Now with USDA, there are limitations on where the property's at, and there's also income price point limitations as well. There are some other options as well. With that, I want to go a little bit deeper with you and talk about financing options. And I've interviewed a local mortgage broker in our area, and I'm going to share the best of that interview to discuss what's possible to get 100% financing for a new home or an existing home in this changing market.
Today I'm with Jamie Black. And Jamie, you want to introduce yourself a little? Tell us who you are.
Hi, I am Jamie Black. I am the Director of Business Development with Rapid Mortgage. I am also a licensed loan originator. So everything that I tell you is from experience, current, past. I've been in the mortgage business about 6.5 years here in Sarasota, Florida. So, I have dealt with obviously the changes in the market that have come the past couple of years. So when you had reached out and asked me, about doing this and kind of bringing everything back to perspective, coming into what we all can kind of see as a shift, I was obviously super interested to jump on that opportunity to help you out with that.
Jump right into that and tell us about this shift. And from your eyes as a lender, we've seen a real crazy time where rates went way low and a lot of people are buying, but yet we've had so many cash buyers that finance buyers had a very difficult time purchasing a home, which obviously is not so problematic anymore.
As loan officers, we were all super, super busy in, 2020 and 2021, but a lot of that was refinancing because, you had people taking advantage of the equity that they had in their home and the super low interest rates and refinancing, which was great. You did have a few people that, missed the boat waiting for rates to drop lower, which, how much lower could they have gone in that period? That's, a craziness. But yes, you're, absolutely right. The amount of cash buyers that were in this market, and not only cash buyers that were in the market, but cash buyers that were willing to pay above and beyond asking price for these homes, definitely pushed a lot of the, first time home buyers, people just starting a family that maybe are, trying to move out of their condo and purchase their, a bigger home. Even if they owned the condo and had the equity, they didn't necessarily have the means to come up with an appraisal gap or, to come in, 20, 50, God, we've heard stories of $100,000 over list price for some of these homes. So I think we are seeing that is changing. What we ran into, however, at the beginning of the year when interest rates went up was a lot of your pre-approved buyers were no longer pre-approved at that price point because of how much the interest rates went up. So, there were a lot of buyers that, were super discouraged because they weren't getting what they wanted. And then all of a sudden, you can't even get what you want at that price. Now we have to go even lower. Or, there were a lot of options, if you did work with a good creative loan officer, changing loan programs or, going into a program with less money down, may have helped a situation. So it was really just going back to the drawing board for us as loan officers with a lot of these buyers on, okay, what is your goal now? Because obviously with the rates increasing, that definitely changed. So I think our financed buyers are going to have a much better shot. It's obviously, I think everyone's kind of settled into the fact that this is where the interest rates are now. I think we did see a lull mortgage application market for a little bit because everybody was so up in arms about, oh my God, the interest rates increased so much. But really, they're still low from a historical standpoint. So we keep saying, marry the house and date the rate. Because if interest rates do end up going down again, you can always refinance. But, I think that is the biggest thing for us to educate buyers. And even some of the newer agents who, I know when we spoke the other day, a lot of newer agents that got in the past, 2.5, even 3 years, they haven't had to deal with financed offers.
Well, I kind of want to dive in a little bit because I think what you kind of discussed is buyers have been shut out in this marketplace in this craziness with multiple offers on the table. A lot of sellers choose to take the cash. And I know most of our sales have been cash just because the seller had a choice of offers and they're going to take the cash, leaving the finance buyer out of the marketplace to buy even when interest rates are low. So,
Right.
So now that they've adjusted, we don't have the same impact of buyers. So the finance buyers have a chance, a much bigger chance of purchasing a house right now. I always think from the perspective, a buyer has two choices. They either rent or they buy, right? So long term, if you've rented in the last year, interest rate or the rentals have gone up 30% in some cases. And so have our interest rates.
Yeah, but at least your interest rate is fixed. And next year when it comes time, to pay your mortgage again, you're still at the same interest rate and not, that's not increasing, obviously. And this is, one of the things that we go over with our buyers. Yes, your mortgage payment may increase if your taxes increase or if there's a change in your homeowner's insurance, obviously. So, but your interest rate is fixed. We're not coming in the following year and saying, oh no, guess what? If you're in a fixed rate mortgage, obviously, if you're an ARM product, that's obviously completely different. But right now we're still in a market where fixed rate is better than adjustable. For the most part, most people like that comfort of the fixed rate mortgage. And, a year down the line, your landlord isn't coming to you, the mortgage servicing company isn't coming to you and saying, okay, we're raising your rent $1,500. I heard crazy amounts that they were increasing rent. And, listing agents don't necessarily need to be afraid of FHA or VA financing as long as the home is, pretty much livable and doesn't need major repairs. An FHA mortgage and a VA mortgage are perfectly fine to accept on, one of your listings. And especially, I know we spoke a lot about VA buyers. If you have a veteran that is able to utilize their VA financing, there is no longer a limit on the amount that they can borrow.
Well, that's a big deal. I think a lot of people don't realize that. I mean,
Yes.
old school, we're so used to the idea that there's limits on how much you can borrow on VA financing. So are you telling me that if I'm a veteran and I can qualify for $1 million mortgage, I can get a VA loan for $1 million?
Yes.
And
yep. As long as your entitlement is there, as long as, when we put everything in the system, as far as your income, your credit, your assets, your liabilities, all of that stuff, as long as when we run everything through, it's coming back with an approved eligible, from our underwriting finding, yes, you can take advantage of a 100% financing on a VA loan with no loan limit. So, that could be huge too. There are obviously still closing costs involved with that. In previous markets, you have a lot of VA buyers that have bought previously. And, just because you've used your VA loan once doesn't mean that you can't use it again. You can use it subsequently, as long as you're getting your entitlement back each time. If you do have to pay a funding fee, if you're not 100% disabled as a veteran, your funding fee does increase, but that's rolled right into the loan amount. So it's not like you have to come up with that money. But you can use your VA loan multiple times. So, you have VA clients that, well, the last time I bought my home using my VA loan, I didn't have to pay any closing costs.
Right.
Why is that? Well, in the previous market, sellers were offering seller credits to help get their home sold. We haven't seen that in the past, 2.5, almost 3 years.
Right.
Because we didn't need to. Sellers didn't have to give up anything. The buyers were giving them everything they wanted.
Well, not only that, Jamie, I'll interrupt you. I mean, not only were the sellers not giving anything, we had this problem called appraisal gap.
Yes.
So how do you get 100% financing when there's you are liable for an appraisal gap?
And that's exactly. So that is, a lot of the problem as well. Some veterans were fine with it and others, didn't have the extra 10, 15 grand to make up for these appraisal gaps. So I think we're going to see.
Just assuming somebody doesn't know what an appraisal gap, define what an appraisal gap is and how that is problematic for a buyer if they only have a limited amount of money to purchase a house.
So your financing is based on your loan to value ratio. So when you go in with your contract, let's just use easy numbers at, $500,000. The home is being listed for $500,000. You as the buyer, you go in right at that $500,000 mark. Your offer gets accepted. You're doing finance, let's just say VA financing 100%. The appraisal gets done. It comes in at 490. Now your loan to value is based off of that 490, not the 500, but you're still required to purchase it for 500 based on the contract.
Well, how do you do that? How does the buyer do that? If the lender's only willing to loan up to 490, but they have a contract for 500, who makes up that money?
So it's either an appraisal gap, which was a huge thing that was put in a lot of contracts that the buyer was willing to pay up to X amount of dollars if the appraisal came in lower. So in this situation, if our buyer had said they were willing to go up to a $15,000 appraisal gap because they had, some money sitting in a 401k that they could tap into, or could get a gift from, grandma or mom or dad, which is always an option. They were able to that contract was still go ahead. In the event that there was not that agreement in the contract, it's obviously then up to the buyer's agent and the seller's agent to come to the table and say, okay, our appraisal came in $10,000 low. We don't have the money to make up that $10,000. Can your buyer come down that $10,000 so that we still have an agreement?
You mean your seller?
Or seller, yes, sorry.
Right.
Seller, no, I'm not willing to do that. In every instance in that case, you can walk away from the contract and there's no, you can get your escrow deposit back. That's it. Now, if maybe the buyer says, okay, I can come up with 5,000 of that $10,000 gap, and the seller says, okay, we can meet in the middle. Let's reduce the purchase price to $495. The buyer still has to make up that additional $5,000. The seller's, dropping the purchase price $5,000, and the contract can still continue and go to closing. So that is, and that was one of the biggest things for everyone to try to wrap their head around, was that appraisal gap.
So just to define, so if a buyer made an offer on a property and they say, look, we're gonna offer 500,000 and we're willing to absorb a $10,000 appraisal gap, they negotiate that, they pre-negotiate that with the offer. But that means that the buyer's gonna have to come up with $10,000 in addition to their down payment?
Yes.
And they're agreeing to do that up front.
Yes.
Okay, but if it's more than 10,000, then they're not obligated to make that purchase.
Right. So that was, that was a big negotiating tool for buyers that wanted to utilize financing with, the cheaper mortgage rates at that time, because even people that had, investment accounts or cash that they could pull from, with interest rates being so low, a lot of them wanted to take advantage of the ability to utilize financing. We did have instances where people would waive the financing contingency and basically write it as a cash offer to get their offer accepted, but still utilize financing. And I think we're going to see more, obviously, seller concessions being utilized, especially if buyers are having to readjust their expectations as far as how much they can buy because of the increase in interest rates. There's many options for buyers to be able to get qualified with as little money down as possible.
Well, that's one thing I really wanted to focus on, is because a few months ago, the 100% buying option really wasn't on the table. Because even if you're a vet and you can qualify for 100% financing, we had this issue of appraisal gap. So even if they were to secure the contract, they had to come up with an appraisal. So that would not allow a vet to get a property with 100% financing in the market that we were in a few months ago. And so that's kind of what I want to focus on, is 100% financing right now is very, very possible. And obviously with the VA, are there other options besides VA that somebody can get in for no money down or just very little down with financing?
I mean, we do always have the FHA option, which that is as little as 3.5% down. And the common misconception is that FHA is the first time homebuyer program, which it really truly is not. FHA is the Federal Housing Administration, meaning that it's a government backed loan. Some of the FHA, things that aren't necessarily favorable are you have, private mortgage insurance on the loan for the life of the loan. That's calculated based on the loan amount. Obviously you can refinance out of that once your home does have enough equity, which is normally at, that gets dropped off in a normal conventional loan at 78% automatically. You can request it earlier, but the common misconception is, okay, if you're not getting an FHA loan, you have to put down 20%, which is not the case. The true first-time homebuyer program is actually a conventional loan product where you can put down as little as 3% as a first-time homebuyer. If you are purchasing in different areas where the area median income may be a little bit lower, you can qualify for what is called Home Ready or Home Possible. That gives you a reduced mortgage insurance premium, because if you're putting down less than 20%, you are going to have mortgage insurance monthly until you reach that point where it drops off. Or you can request, obviously with the way our housing market is, you're probably going to get there sooner with having an appraisal. If your servicer allows that, you can get a new appraisal done and potentially drop that mortgage insurance. But they get a reduced mortgage insurance premium and reduced interest rate. So, but if you're not a first-time home buyer and you still don't want to put down 20%, you can put down as little as 5%. You are going to have, however, that monthly mortgage insurance premium. There are options to pay that all in one chunk up front, depending on, where your credit score is. The mortgage insurance premium is kind of like your interest rate. It's factored on, your credit score, how much you're putting down. If you have a co-borrower, that's, one thing that's a little different than the interest rate. A lot of times, if you have a co-borrower that has a really strong credit score, that can help your mortgage insurance premium.
Because the idea of 100% financing is very intriguing. As we discussed, that was really off the table for the last 2.5 years. Even if a buyer can qualify for it, the seller wasn't interested. So
Right.
now the seller is very interested, and we have inventory backing up, and we even have builder inventory backing up. So I've got a couple questions on that one. First off, are all these rates applicable for new construction?
Absolutely.
And now
Absolutely. And
I think that's the big one, because a lot of people think that because the builder's selling new product, that the builder controls that whole process, even if the builder has their own lender.
which most of them do, and builders do that with their shiny little incentives.
Mhm.
We all know nothing is free. They're not giving away stuff. They're not giving you, 15 grand in incentives for free. It's built in there somewhere. So, but the builders lenders entice you with those things. And a lot of times we see all the time that the loan falls apart because the builder's lender isn't as incentivized as another lender to get that deal closed. A lot of them, if they're unable to, because as lenders, we also, there's the government standards that we're all given. And a lot of banks put overlays on top of that they can't lend on. So just because you as a buyer or one of your clients isn't approvable at, say they want to go to their local bank that they, deposit all their money in from their paychecks every week. A lot of them, if they can't do the financing, will still honor the incentives if you use another lender, because obviously they don't want an empty house sitting. They still want to get it sold. Right. So a lot of times they will still offer those incentives, working with a lender. Everything is negotiable.
So that's a good point. So if a buyer goes to a builder and the builder has a lender, that buyer is not obligated to use that lender.
Nope.
Because the perception is that they are. That's
Mhm.
part of the package of purchasing that home.
No,
But you're
and
saying, no,
everything
no, a
is,
buyer's writing the check, so they can pick, we don't want to use the builder's lender, we want to use our own lender. They have the option to do that.
yeah. And I mean, like I said, everything is negotiable. If you have, as the buyer and you're going to new construction, same thing with working with the builder's sales team rather than having your own agent representing you.
Right.
Obviously the builder has the builder's best interest at heart.
Of course.
So, if you're using their salesperson, their lender, their title company, where do you as the buyer come into this transaction? If something goes wrong or you have questions, are your questions being answered for you, or are they being answered to benefit the builder?
Yeah, and
So,
that's
you know,
an
that's
excellent
where,
point. I mean,
yeah, I
if you
mean,
do
if,
buy a new home, you're not being represented if you don't use an agent. You don't have a fiduciary on your side that could say, wait, I think you should consider using or at least interviewing other lenders, even though the builder wants you to use their lender. I think long term, there could be a benefit for you to select somebody else in your financing.
right. And I mean, it might not work out all the time. There might be instances like, no, they're actually giving you a great deal. Like you're getting a great interest rate. You're getting, your quartz countertops over the granite that you want, because of this. So, and we're going to be honest and upfront because, hopefully down the line when they want to refinance that mortgage, they'll remember, oh, let me call Jamie Black. She was the one who took this time to explain my mortgage to me.
Was off the table a few months ago, and now 100% financing is very much back on the table. It's something a buyer can secure if they're a vet. Are there other programs now? I know I've heard of the USDA farmland. Do you have any insight with that?
Yeah, USDA can also be 100% financing. With the USDA loan though, it is property specific.
Okay.
So, it's like most of Lakewood Ranch actually qualifies for USDA. However, there's income restrictions. So a lot of the properties sold in Lakewood Ranch don't qualify for USDA, because to be able to purchase that property using a USDA loan, you're stuck at income caps. So with USDA, and another 100% financing option, or, we have the down payment assistance programs, which might not necessarily be 100% financing, but it does give the buyers help towards their down payment and closing costs. Those as well have income caps. So, those are the things that we have to remember besides VA on the 100% financing or down payment assistance side of things. There are going to be those income caps. So a $600,000-$700,000 property probably is not going to fall into that category, because the requirement to purchase that property, their income is going to be too high. So, that's something obviously that when the buyer comes to us, hey, you're in this, nice little, but on the 100% financing side of things, I mean, just the veterans, the availability of this for them is huge, and these men and women have, given us their service to our country. And, why is their loan not looked upon with the same respect as every other loan? I mean, just because a veteran is utilizing their VA loan does not mean they're not a qualified buyer.
Right.
I mean, there are plenty
or
of
a first-time buyer for that matter, right?
Right, exactly. I mean, there are plenty of veterans who, they could do, but like I said, if you're 100% disabled, you don't have that funding fee. If you're a veteran and you're able to utilize that and leave your money in your investment accounts, why would you not take advantage of that option?
Right.
In VA, just like FHA, a lot of agents are afraid of it because there's more inspections, there's more this, there's more that. If the house is inhabitable and livable, FHA or VA financing is, perfectly fine to accept an offer on.
Let's dissect that a little bit. So VA financing, number one, there's no limit on it. So that's not the case with the USDA financing, where it's property specific, and also there's some caps on it. But again, that could be an option, because with USDA, you do not need to be a vet, correct?
Right.
And with the VA, you need to be a veteran.
Right.
But if you're a veteran, you can qualify for VA financing, then that certainly gives you a limitless possibility to buy property with no money down. So the restriction has been the seller for the last 2.5 years. They have been the ones that have put the foot down and said, we're not looking for VA offers because we have a plethora of cash offers. Plus, we want you to sign an appraisal gap, and that would put a no money down 100% financing option off the table for a veteran. So that seems to be off the table now as well. So I guess my question here is, with the VA financing, how possible is this for new construction?
Absolutely possible. And with new construction, the VA is, especially new construction, I mean, it's a brand new home. There shouldn't be any inspection issues with using a VA loan for new construction. So, there should be zero issue with a builder accepting VA financing, or offering it, to the veterans. Most builders will do the normal conventional FHA, VA, USDA financing. That's, part of their wheelhouse. So if you're taking your buyer in that's a veteran, there should be no reason that they're not offered, VA financing if they're able to utilize that.
And one thing right now, the builders have a lot of inventory that's backing up, and they have changed their attitude from where it's been a couple months ago to being very cooperative and creating a lot of incentives. So these incentives, some of these incentives are incentives to upgrade the home, or they're calling it, I don't know what the term is, it's cash. Like, they're giving you so much spending cash to figure out how to use your incentive any way you want to upgrade the home or to put it back in the finance. So you had shared with us some options where There, you can pay your mortgage insurance up front, you can buy your interest rate down, or you can have all of your closing costs paid for. So you can use some of this builder incentive cash to put back in the loan and truly make that a no money down situation, paying the closing costs, paying the mortgage interest rate down, so you qualify for more house. So all that's on the table now, where it wasn't on the table just a couple months ago. Where I see the big change right now is builders actually have inventory housing. They have housing that is going to be complete in 1 or 2 or 3 months, that because we had so many cancellations of contracts, we now have a backlog of homes that need to be sold, and they're brand new homes. And they're brand new homes from a motivated seller, the builder, that's willing to offer cash or incentive, and that you can actually use that incentive to get a no money down purchase. And if it doesn't qualify for the USDA because it's not in the right location or or area, and you're not a vet, you can't get 100% financing, you still can get in for how much? 3%, 5% down?
3% or 5%, you know, just depending on what you're comfortable in.
And you can use that builder cash to pay down your interest rate, to qualify, to pay your closing costs, to pay your mortgage insurance. So it seems like a really good time to buy right now.
Yeah, I mean, you can use any, you know, builder credits, seller credits just on a normal purchase towards any closing costs or prepaids. You just can't use it towards any of your down payment funds. So, you know, you are required, whether it's your own funds or gift funds, to come to the table with X amount that you said you're putting down. But all of that other money can be used, you know, to pay your, you know, we know a lot of times, you know, especially now, the homeowners insurance, with all of the issues that are happening with that, those amounts have increased, which is another reason that a lot of people have now been taken out of pre-approval status, because, you know, their homeowners insurance kicked them out. You know, it went up what would be, you know, $50, $75, $100 extra a month because of what is happening in the insurance marketplace. But hopefully the builders having a lot of this inventory, they'll be, you know, open to, you know, maybe the buyer who's been struggling looking at existing homes and, you know, come across this and like, look, I'm pre-approved with my lender. We already have everything going. We've put in 25 offers and now we're here. Will you accept our offer? Will you still give us what you would give us if we were using your lender? And, you know, hopefully the builders are realizing that they need all of us to work together to help clear, you know, some of this inventory out for them.
Right. Objectively, choices are you buy or you rent. And a lot of people think buying's a dangerous thing right now because the market has fluctuated so much recently when the rates went up, but renting is not a safe option right now. And the thing I love that you brought up to the idea that if you buy and you lock in your interest rate, you're married to the house, but not the interest rate. So if the interest rate goes down, you can always refinance. If the interest rate goes up, you're locked in. You're good. Yeah. And if the property keeps going up in value, you're locked in. And if the property goes down in value, you still are in an ownership situation as compared to a rental situation. And depending on what your life goals are, long term, that certainly has proven to be a better option than just renting forever.
Oh, absolutely. Absolutely. Yeah. I mean,
there is this big thing about the real estate crash and everything's gonna, burn and whatever. But the vision is we're in Florida.
We're Sarasota.
I mean, people are coming here, So I do think, crashes are subjective. And just like in Sarasota, there are neighborhoods that have done extremely well and some, are done okay. I mean, it is very area specific. And being in Florida, we're seeing a huge increase. So even with a crash and everything burning, I do see adjustments, but in Florida, we're not seeing that. You agree?
And yes, and most of the adjustments that are happening is because the seller wanted that $100,000 more than what they really should have listed.
What do you call that? Froth? Where okay, the last home sold for $1 million, so I'm going to go on the market for 1.1.
Yeah.
And then 2 weeks later, you realize, you know what? I can't get that extra, so they bring it back to $1 million, and people think, look, we're seeing all these price changes. Well, yeah, we're seeing people saying, you know what, that's not working anymore. I need to go back down to where things were working.
Right. Come back to reality a little bit.
Let's come back to where the speed limit was safe, not where it was
Yes.
unrealistic.
Yeah, we're not on the Autobahn anymore.
So yeah, it just, when things feel normal again, it feels like we're slow or we're crashing, when really we have a volatile market of people coming here on a consistent basis. And either you buy or renting has not been a good option, not long term here. So, and when you're buying, you've been in trouble for the last couple of years. It's been hard to purchase a property. Yeah, the interest rates are low, but it's been hard to even get the contract. Now is an opportunity where you can get the contract and you can almost, depending on where you're at, either get 100% financing or very little down, which has not been on the table for the last 2-3 years, right?
No. Well, and that's another thing that I think a lot of, which it's one of those things that's on the Florida contract, that it does anybody really, just because you're not putting 20% down or 50% down doesn't mean you're any less qualified or you're not able to put that much down.
Right.
But it may just make more sense for your situation to keep that money in investments, especially when interest rates were as low as they were.
Right.
So the VA loan definitely does not make you a bad or unqualified buyer. Some of them could come in on a conventional loan, no problem. But like we said, why would you? And the same with putting down less than required to not have mortgage insurance, because some of the mortgage insurance, if you have a decent credit score, you're paying that mortgage insurance premium up front might be a whole lot less than that extra 10% that you're going to put down.
It was absolutely valuable. You are a wealth of information. The biggest takeaway I got today is if you're going to borrow money, you need to talk to a local professional like yourself and somebody that's well respected in the community, which you are. So with that, Jamie, in closing, give us your information, your name, contact information. Again, I'm going to leave it below in the link so you can reach out to Jamie direct. But Jamie, you've given us a lot of information, and I'm going to take this whole soundbite and kind of cut it up a little bit so I can put it in different videos. But again, Jamie, tell us who you are, and we'll sign out.
Jamie Black with Rapid Mortgage Company here in Sarasota, Florida. My direct line is 941-444-2937, and email address is jblack@rapidmortgage.com. Feel free to reach out to me with any questions that you may have, whether just as an agent or for your buyers.
Great. Thank you. With that, we're going to close out. Jamie, thank you so much.
Thanks, Troy.
All right.
Now, I hope you found that information helpful. And if you did, please hit the like button, hit the subscribe button, and I hope to see you on my next video.